Mike. So a really frequent question we get is, gee, the economy is just in terrible shape. The virus is really still there and not getting better that quickly. So why is the stock market on a tear?
You just have to look at it from a supply and demand perspective. And all those bad fundamental indicators, they don't actually buy or sell stocks. It's simply supply and demand. So the demand for stocks has clearly increased and the supply has been decreasing. And then you think about what the Fed has done. The Fed has artificially increased the demand for stocks, not by making them cheaper or anything, which they would never want to do, but that would make them look attractive, but by just making everything else look so expensive that, relatively speaking, stocks look cheap. So
right. So you're basically saying that fundamentals don't matter. If there's more money and there's fewer stocks, it doesn't matter what those companies do. The money just needs to go somewhere.
On a high level, that is the most important driving factor, because there is no single fundamental indicator that is that reliable at predicting if stock prices are going to go up and down. But we know for a fact, if the stock market went up, it's because there were more buyers than sellers. So
Right.
Supply and demand is the only
Right.
thing that actually works all the time.
Right. And the issue today versus 20 years ago is today we have these index funds that most people are using. So they're just buying across the board versus allocating capital to winners and losers. So we're seeing some of that in the divergence in returns in the S&P. But generally speaking, if there weren't index funds, you would see a lot larger divergence between the winners and the losers in the allocation of capital. Is that a fair statement?
Yeah, right now you see divergence between the companies that are in the indexes with big index funds that track them. So, if you get in the S&P 500, you're basically good to go, right? You're always going to have this big inflow of capital. So you're seeing divergence between companies that are in these indexes and not. But yeah, exactly to your point, 20 years ago, even the companies within these indexes, you'd have more differentiation because skilled stock pickers would be actively saying, I like this stock, I don't like this stock, I'm going to bid up this price, not this price. And that just it's just not, it's less the case now for sure.
Right. So arguably index funds are a poor allocator of capital or investment capital to companies because they're really not allocating it to the winners. They're just allocating it to everybody.
Yeah, an index fund is the simplest momentum strategy, investment strategy you can create. It's just the big companies, I'm going to allocate more to them. And if they do well, I'm going to allocate even more to them. And if they do poorly, I'm going to allocate less to them. It's just a basic 101 momentum strategy.
Mm-hmm. So it's interesting. So why do managers then have a tendency to underperform the index, or at least that's the perception?
Well, on average, the average active manager performs in line with the index before fees and then underperforms after fees. So you'd say the average manager performs on average about average, which isn't really a hot take. But what you have is big differentiation. If one active manager is going to outperform, that means that there has to be an active manager that's underperforming because you outperform at someone else's expense.
Mm-hmm.
So you put these things together, your performance should always be average, and then active funds are more expensive than passive funds. So on average, in aggregate, they're going to underperform the index.